Welcome to our video on credit risk analysis. Today, we're going to explore an essential question that many financial professionals ask themselves when dealing with client companies. Is it possible to identify which indicators influence the credit risk for each client company in credit risk analysis? Credit risk analysis is a critical process that helps lenders and investors assess the likelihood of understanding which indicators drive this risk is vital for making informed decisions. In this video, we'll delve into the world of credit risk analysis and break down the complex concepts involved in identifying key indicators. We'll explore the different types of indicators, how they interact with each other, and what they reveal about a company's creditworthiness. By the end of this video, you'll have a deeper understanding of how to identify the most influential indicators for your client company. Credit risk analysis involves evaluating various quantitative and qualitative factors that affect a company's ability to meet its financial obligations. These factors can be broadly categorized into three groups: company-specific, industry-specific, and macroeconomic indicators. Company-specific indicators focus on the internal characteristics of the business, such as its financial health, management quality, and competitive position. Examples include debt-to-equity ratios, interest coverage ratios, and cash flow margins. These indicators provide insights into a company's ability to generate earnings, manage its debt, and maintain liquidity. Industry-specific indicators examine the external environment in which the company operates. This includes factors like industry trends, competition levels, and regulatory changes. For instance, if a company operates in a highly competitive industry with low barriers to entry, it may be more susceptible to credit risk. Macroeconomic indicators consider broader economic conditions that can impact the company's performance, such as GDP growth rates, inflation rates, and interest rates. These indicators help assess how external factors might influence the company's ability to repay its debt. To identify which indicators have the most significant influence on a client company's credit risk, you need to analyze these different categories together. This is where things can get complex, as the relationships between these indicators are often non-linear and interact with each other in subtle ways. One approach is to use statistical models that incorporate multiple indicators to estimate the probability of default. These models can help identify which indicators have the most significant impact on credit risk. Another approach is to use expert judgment, where experienced analysts assess the relative importance of different indicators based on their knowledge and experience. To summarize, identifying the key indicators that influence credit risk for each client company involves analyzing a range of quantitative and qualitative factors. These include company-specific, industry-specific, and macroeconomic indicators. By understanding how these indicators interact with each other, you can gain insights into which ones have the most significant impact on credit risk. The essential points to remember are: company-specific indicators provide insights into a company's internal health. Industry-specific indicators examine the external environment in which the company operates. Macroeconomic indicators consider broader economic conditions that can impact the company's performance. Statistical models and expert judgment can be used to identify the most influential indicators. That concludes our video on identifying key indicators in credit risk analysis. We hope this explanation has helped you understand the complex concepts involved in evaluating a client company's creditworthiness. If you have any questions or would like further clarification on any of the points we covered, please leave them in the comments below. Don't forget to like this video and subscribe for more content on finance and risk management. What do you think is the most critical indicator in credit risk analysis? Share your thoughts with us.